We don't expect this week's data to be a game changer. Actually, we do think that, like most of the market participants, we're going to have a rate cut, but much later this year, potentially December. The US is still pretty strong. And actually, if you look at inflation and you just remove shelter, which is about 30% of the CPI, you would see that the inflation figures is aligned with pre-COVID levels. And actually, why should you remove shelter is because when you renegotiate your rates, you do it for 12 months, 24 months, 36 months. So you always have this lag. So it makes sense right now just to look at inflation, but actually deduct the shelter component of it. And if you look at that, inflation seems to be under control. And on top of that, the Fed has two mandates. One is inflation, and the second one is the economy. And as you've seen lately, even though the US economy is very, very strong and very robust, we have early signs of a slowdown as well. So we do think that the Fed will be, as you mentioned, data dependent, but we don't expect anything big this week. We would be extremely surprised if we had a move from the Fed or very bad figures from the CPI itself.
We are looking at record closes on Wall Street, on the S&P as well as the NASDAQ. Are things looking overvalued?
Yes, we do think that the equities are 15% overvalued. Actually, if you look at the main impactors of the S&P this year, you have 5 stocks which are doing fantastically well and accounting for most of the upside on the S&P. If you remove the Magnificent Seven and you look at the S&P over the last quarter, you would have seen that actually a lot of stocks are not doing so well this year. Year to date, last week when I did the job, 40% of the S&P components, were negative year to date. So you have a lot of dispersions on stocks, and I think people keep too much looking at the index without recognizing that the index is actually looking at the Magnificent Seven.